Hi, this is Randy Finney with Right Side of the Chart, and today is Sunday, August 26, 2012. And what I'd like to do in this video is a follow-up to the post that I made Friday after the close. That post was regarding Apple as a potential short, and more importantly, what I want to talk on tonight is we may be looking at a pretty objective time to short the broad markets here. As I mentioned in that post, my preference for the last few months, in fact most of this year, has been to trade the best individual stock patterns, whether long or short, and really stay away from trying to trade the broad markets. But I think we may be seeing things change here, and I'm sure there are a lot of traders out there that are more comfortable shorting the indexes or going long the indexes for the diversity and relative safety that you have in that versus individual stocks. So without any further ado, and before I jump into the charts, let's take a look here at the Nasdaq 100 and really what it's made up of. These are the holdings of the QQQ. This is a tracking ETF for the Index 100, the Nasdaq 100 that is. And as you can see here, these holdings were as of July 31st, so fairly recent. The top 10 holdings in the Nasdaq 100 make up over 56%. Let me repeat that. 10% of the 100 holdings, or holdings in the QQQ or the Nasdaq 100, represent over half the performance of that index. As I talked a lot about Apple has bounced between the 19 and 20% range, and that's of course after a rebalancing they did just about a year or so ago. When Apple got to that level, up around the 19-20% level, they did rebalance. But of course Apple has been the juggernaut that it is, has been doing very well and clearly leading this index up to new highs here. And now as we take a look, as I mentioned in the post on Friday, Apple, although it is by far the largest holding in there, the top 10 also make up the bulk of the entire NDX 100 or Nasdaq 100. As you can see here are the weightings, and if you add up the first 5 here, the top 5 holdings alone make up just over 42% of the Nasdaq 100. So what I'm going to do tonight is take a look at the charts here on the top 10 holdings. In fact, I spent some time in the post on Apple. I put up a few static charts and explained my thinking on that stock the other night, so you can take a look at that. So really we'll go through the remaining 9 here. I actually did go through the entire 100 stocks in there, looking at it chart by chart on different time frames, and I may, if time permits, I might do a separate video covering some of those other stocks, certain patterns that stand out. But again, let's take a look at the top 10 here, because that is really going to determine the performance of the Nasdaq 100 to a great deal, and being that that's the leading index, I think that's the one that we should have our eyes on right now. So here is Microsoft on a weekly time frame, and I plan to go through these. I'll try to talk fast. I've vowed to keep these video updates a little bit shorter in time than I've been doing in the past, so I'll talk fast. You can pause, rewind. We're looking at a weekly time frame here, going back to 2004 on Microsoft. And what sticks out, at least for me, I noted this key multi-year resistance level here. Here's a line, as shown by all these white arrows up top. The price is being rejected at that level. And what we can see here back in 2008, early 2008, late 2007, at the end, the peak of the last bull market, when euphoria was at its high, we saw a nice breakout. And look at the size of that candlestick. That is just one ginormous, we'll call it, weekly candlestick on Microsoft, and that's what bullish traders like to see in a breakout, a big powerful candlestick. And I don't have volume shown here, I'm sure it was on decent volume, but that was all she wrote for Microsoft. So what we saw here was a very nice bull trap. We had 1, 2, 3 attempts, and finally on that third attempt it did manage to punch up through there. Had a lot of buyers jump in, undoubtedly, as Microsoft broke out to new multi-year highs, and then of course the bottom fell out. You can blame that on the financial crisis, say what you want, but in my book that is a bull trap. As clear as they come, prices fell back down, came back up, tried to retest that level again, failed. Went down, we bottomed out, and the bear market ended in March of '09. Prices came up very sharply, right to that level again, stopped, rejected, tried it again, fell back. Here we are, fast forward a few years later until recently, and we had another attempt and finally another breakout of that level. Unfortunately, that breakout didn't hold. So as of now, I'm viewing that as a second major bull trap, and that punch through to new highs. It wasn't as exciting. We don't see the price action that we did back here, but as of now, we've fallen back below that line. So I do consider this a key resistance level. Here we are today. We sit just below that level. So we may have, obviously we don't have the volume of traders trapped in that Microsoft, but I'm sure there were quite a few bulls that took that on the breakout and are now trapped below that level and remorseful. So we'll see what happens from there. If you look below, let's take a look at this upward sloping line. What we have here from these 2 points, we have an upward trend line. So we have higher highs, and if you take a look at all the oscillators and indicators below, MACD, RSI, on balance volume, all of these clearly show negative divergence as they're making lower highs. So that's the Microsoft weekly. And moving down the line here, Microsoft was number 2, by the way, behind Apple as far as holdings. Google, here's a weekly chart of Google. And on this weekly chart, what it looks like is one big old, you could call this a rising wedge, but what we can say for sure here, we do have a nice multi-year trend line going all the way back to 2004. So we'll keep an eye on this trend line. Obviously, that would be bearish if Google broke below it. Now, right now, prices are all the way up against this uppermost trend line, or top of a wedge, if you want to call it that. We have 1, 2, 3, 4, 5. This is the 6th attempt to get through that. So prices are at resistance. Let's see where they go. If you take the glass half full point of view, if you're more of the bullish camp right now, you might say, well, okay, that's a level, we're going to punch through there and prices will take off and run, and that may be the case, folks. But currently, if you look below, as many of the weekly charts and monthly charts that I've gone over recently, you have just across the board negative divergence. If you look at this line versus these lines, you see prices making higher highs, and just about across the board, the indicators, you've got your MACD, RSI, on balance volume, just about anything you put up there is making lower highs along there, so negative divergence again on Google. Now let's jump forward here and look at a 2-day chart. This is a 2-day time period, so every candlestick represents 2 days of price action. And what I wanted to do is zoom in here on the RSI. Okay, take a note, take a look. The red line is what is considered overbought in an RSI. That's the 70 level. And let's just take a look here. I am going to move my cursor along, and let's take a look at what happened every time prices hit or exceeded that 70 level. And so if you look at the crosshairs, basically the vertical line is on the RSI 70 reading, and then you can see what prices did from this point here down to here. We had a nice correction. That's pretty sizable, looking to be about a 10% or so drop from Google. And we fast forward, and here it was overbought for quite a while. There was a correction right away, or shortly after the overbought reading, and then prices managed to stay overbought for a while, pushed back up, and to this peak here. And let's see, if you look to the right, follow the horizontal line over, your prices were at about 626, 630, and went all the way down and didn't stop until Google reached about the 435 area. So again, that was triggered by this, what I refer to as an extended overbought reading. We got above 70, even though we dipped below it, prices never fell back towards the mid-level, the 50 level. You typically want to see prices come back to the mid-range or lower before they punch up again. That helps offset or alleviate those overbought conditions. So the longer you stay overbought, typically the bigger the ensuing correction is, as you can see here. Okay, fast forward, overbought. Prices began to get overbought around this level here and stayed overbought for a little while, and that's something prices can do. Overbought in itself is not a sell signal, but it is definitely a caution sign, and as you can see from this level here, we had pretty decent correction. Or had you been swing trading this off such extended overbought conditions, you could have shorted Google up in this area and held that short. Again, looking at prices around 635, and Google came all the way back into about the 470, 475 area over the next few months. So here we go. Fast forward to the next overbought reading, and I think y'all can see the pattern here. When you're overbought, sometimes it takes a little time to play out. Sometimes it starts to play out pretty quickly. But the end result is prices rarely go much higher, and there, at least historically, has been corrections. Here's the next overbought level, 70 or above, and boom, we had a correction shortly thereafter. And here we are today. So I think there's been enough said on that. Prices may want to remain overbought here for a while. Yes, Google can push up, but we're at trendline resistance and looking at a pretty good historical sell signal. Okay, now we're looking at Oracle. This is again a 2-day period chart on Oracle, and what stands out to me here are these trend lines in conjunction with MACD sell signals. And what I mean by that, if you look here, Oracle tends to form these pretty clear trend lines. They're all very similar in duration. And what you'll usually see is once the trend line breaks, if you look down below, you've noticed this one wasn't so clear, but going forward you'll see some pretty clear MACD bearish crossovers. By bearish crossover, I'm referring to when this blue line, which is the fast line, crosses down below the slow line or the white line. That is considered a bearish MACD crossover. This trend line here was a head and shoulders pattern. Here's a left shoulder, head, right shoulder. I had tracked this back on Oracle earlier in the year, and that was the price projection. Prices broke down there, and if you follow the vertical line down, you'll see the MACD crossover. We had a brief cross up and then crossover confirming that trend line break there, confirming the bearish signal. This one we had a little bit of a whipsaw because we did have a trend line break here. Prices shot back up very quickly, but if you notice that the MACD had crossed over with that trend line break, never managed to push back above. So what it tried to do here is retest and get back above that. And again, prices broke back below that trend line. And as you can see, the selling's has been pretty impulsive on each of these trend line breaks. Happened here again. MACD, bearish MACD crossover down below if you follow the vertical line. And here we are today. We do not have a sell signal on a trend line break yet or a MACD crossover, but as you can see here from the posture of the MACD, that fast line is clearly curling down and has been in extended bullish territory for quite a while. So if I was a betting man, which I am by trade, I would bet that is going to cross over very soon. So Oracle looking pretty bearish to me. Okay, here's Intel. This is a daily chart. Intel was recently a short on the site, and it was a short of this rising wedge breakdown. We had a breakdown here of the bearish rising wedge, came back to retest right at about the apex, and then boom, fell down, hit the first target zone, and has floundered since then. Looks more bearish than bullish to me. You can see here a succession of lower highs. We can almost draw, if I drew a trend line down here and you have this horizontal line of support, you could almost draw a descending triangle pattern. But either way, we're looking at prices have dropped off pretty sharply recently, and we're now below a lot of the key moving averages here. I have 200-day, 50-day, 20-day exponential moving averages. We're below all those key averages, and we're testing for looks like the third time in the last few months here, this key support level. So keep an eye on that. Again, stock looks more bearish than bullish to me. Take a look at the monthly chart. This is a long-term trend line going all the way back to 1986, multi-year trend line. Intel Intel reminds me a lot of Apple. It reminds me of Apple and Cisco, which I'm going to cover here in a minute. It's just or used to be a juggernaut in the industry. It came along with the right product at the right time, leader in chips. And as you can see here, the stock was pretty much undeniable for a couple decades, 15 years plus, and has since Intel peaked out back in with the tech bubble in 2000, it's been pretty much dead money since then. It's well off its highs that it made well over a decade ago, and has been slowly drifting lower in this downtrend channel, pretty much going nowhere over that time. So we had the multi-year trend line break didn't happen until looks like late 2005, right around here, and that's dead money. Compare that to Cisco. Look at a monthly chart on Cisco. Same story. Cisco was just a powerhouse throughout the 90s into the tech bubble, and just like Intel has gone nowhere since. And one day this will look like those charts. Apple, it's hard to say how much more it has to go, but what I have 100% confidence in is that over time Apple will meet the same fate as every other company. I'm not saying Apple is going to go away or die, but let's take a look at the life cycle of a business. I remember these charts back from my days in college. It's pretty much any company over time is going to follow this cycle, and you have one or two paths here. At the startup phase, rapid growth. That was that sharp run-up we were looking at in Cisco that we saw in the 90s, as well as Intel, and where Apple is now. And my guess is Apple's somewhere along these lines. And we could head up for years, but Apple's not going to continue this growth rate forever. At some point, like every other company, they're going to hit a maturity phase and then start to decline, as we've seen in Cisco and Intel for the last several years. Now, this is a critical point, and this is years ahead, folks. So don't take this as a call on Apple, where it's either going to go through a rebirth phase or it's going to hit this death phase. RIM is a great example. RIM clearly seems to be on this downward death spiral. So let's not spend much more time on that, but Apple is somewhere along this, and my guess is already towards the maturity phase. I think that's pretty clear. But again, we're looking at a short-term call right now on my short on Apple. Okay, moving on. I'll try to speed this up. We've got just a few more to cover here. Here's Amazon, looking at a monthly chart. Again, multi-year, well-defined uptrend line. We did have a break during the last bear market, in the panic sell-off. That did bring Amazon below, but we have 1, 2, 3. That one was slightly breached. Several touches here on this multi-year uptrend line. Now, what stands out to me here are these, what I call sub-uptrend lines, smaller uptrends within the primary uptrend. What I've noticed when looking at these is each of these successive uptrends have become smaller in scope and duration. These were longer, more vibrant bounces off that trend line, and as time goes on, you can see the trend lines, the slope of the trend lines are decreasing, as well as the how far the bounce goes. So Amazon is clearly, obviously it's in an uptrend, it's in a growth phase, but clearly that growth is slowing, and at some point it's slowing quite considerably here when viewed out on this time frame, and at some point we're going to break this trend line, and Amazon will enter that phase of dead money or slightly declining growth, as we just looked at in Intel and Cisco. Okay, now here's a weekly chart of Amazon. Amazon being the 6th largest holding in the NDX. Looking at the weekly chart, we've pushed up against. Amazon's trying to punch through its all-time highs, challenging that high. So that level, this line here, or the previous high, is resistance until that level is clearly broken. Looking at the history of Amazon, we see these uptrend lines, and there's not any uptrend that lasts forever. So these have broken in the past, broken, retested. Here I have 2 uptrend lines that I've had drawn on the Amazon weekly, both of which are broken now. Prices have pushed back up. Yes, a breakout to new highs would be bullish. Of course, on the downside here, you do have all your indicators and oscillators lagging. Here's a MACD. Again, you're looking at prices making higher highs and all your indicators and oscillators down below. MACD, RSI, on balance volume, pretty much across the board negative divergence there. So if we do to punch through to a new high, I'm not going to be on board. I'll let that stock, let the bulls chase it. I would rather watch Amazon go up another 50% from these levels, not being along on the ride, than chasing a stock showing such red flags, on trying to break out or push to a new high. So again, I think Amazon, as I look at the charts, is more bearish than bullish, in my opinion. And finally, real quick, here's a daily chart of Amazon. These yellow lines have it in a sort of a bearish rising wedge here. And if you look at this yellow line here, the top of the wedge, compared to these are the daily oscillators and indicators below, the MACD, RSI, on balance volume, the money flows, pretty much just like on the weeklies, negative divergence across the board, even on this shorter time frame. So again, I would be very cautious of a new high, a new breakout in Amazon, as I don't think that would go too far. Maybe weeks at most, but my bet would be that it falls back below this level and probably comes back pretty hard when it does. Okay, QCOM holding number 7. We're looking at a weekly chart here, and basically a pretty clear rising wedge, which has broken down. That broke down, let's see, back a few months back, and prices have pushed back up to retest that wedge from underneath. So we're still quite a ways from making breaking out to a new high, and being that QCOM is retesting from underneath of a broken bearish falling wedge. Again, like everything else, negative divergence is clearly in place on that when the wedge pushed to new highs there. If you take this line and look at these lines down here, negative divergence across the board. Now jump into a monthly chart on QCOM. I have two trend lines drawn. This trend line comes here, the white trend line comes off the 1992 lows. That was broken back in the last bear market, back here in late 2008. And prices have since, come back up, but they're underneath that trend line. And I also have this yellow trend line drawn here that starts back in 94. We have a couple tags there, so 1, 2, 3 clean touches. Keep an eye on this, and again, that would be a longer term break of these long-term monthly trend lines. Would help validate if prices start heading down here soon. These will help determine, are we looking at just a correction and another buying opportunity, or more likely the start of a new bear market? So that's why I continue to keep an eye on these monthly and weekly charts. Cisco I already talked on earlier, so I won't spend a lot of time. That's pretty much been a dead money stock. I don't have much of an opinion on Cisco, bullish or bearish. I will say that. Here's a weekly chart with a possible head and shoulders. Not my favorite, but that's a possibility there. So you'd have this down-sloping neckline, something to keep an eye on. But as far as looking at the daily chart, I don't have much of an opinion on this one. Okay, here's Kraft Foods. We're finally looking at a non-tech. I believe the only non-tech, well, that and Comcast in the top 10 holdings of the NDX. So what jumps out at me at Kraft Foods is, typically you have the 70 line as an overbought indicator on the RSI, although every stock is different, so I always try to look to see if there are a series of peaks at different levels. And what I've done here is added a RSI, a yellow line at the 66.25 level on the RSI. And again, like we did earlier, if you would just follow the vertical line down, I'm putting the vertical line on the RSI overbought readings. Again, I'm considering overbought on this stock, level of 66.25 or higher. And all you have to do is just look immediately to the right of the crosshairs, what prices have done. And every single time there's a good correction. 2, here's our second reading up here. Look at that correction. We touched it right here, and there was a brief but very sharp correction. And again, we're looking at a weekly frame here, so this is over a couple months from this peak down to this level. What was that? 3. There's 4. Short here, cover here. Well, not always so easy, but it can tell you when to short. It can't always tell you when to get out. But again, that's why we look at the shorter term charts. I think this is number 5. Short, cover. Actually, no. If you went short at this peak RSI reading, the stock was around $37. It didn't bottom until this level, so quite the short there. And again, you can go down the line, do this on your own chart. We had a very small, brief correction there, but I went through this, and there's not a single time that we had those overbought readings that we didn't have a pretty significant correction within short order. Sometimes we'll have an overbought reading, prices will come back down and then hit that overbought level again, and usually I call that an extended overbought reading, where you have one overbought reading, prices dip below that line, come back up, and usually the second time around you have a more significant correction. So where are we at today? Once again, we are over that level, as you can see down here where the crosshairs are, and we haven't even had anything close to correction yet. So to me, it's just a matter of when, not if, prices are going to correct, and correct sharply on this. And again, Kraft is holding number 9. Here's a 2-day period chart of Kraft. Trend line going back to the bear market lows, or I should say, the bear market lows, beginning of the bull market in March of 2009. Pretty clear uptrend line. We've had a few spikes through there. That's nothing. I'm fine with those brief tails or spikes down through those trend lines, but we have had multiple touches, and that's something to keep an eye on for a longer-term sell signal in Kraft. Again, stock looks strong. I will give it that. I think some of the indicators, like the on-balance volume, I believe was strong on this one, and some other things out there. But we do see like everything else, just about everything else out there, we see most of the indicators and oscillators lagging behind on Kraft. So a longer term does look bearish to me. Okay, folks, wrapping it up. This is the last stock, the 10th largest holding, and this is Comcast Cable, a company I think everybody loves to hate. Worst customer service company in the world as far as I'm concerned. Anyways, we're looking at a weekly chart here of Comcast, and you have RSI readings. Here's the RSI 70 overbought level, and again, this is just another one that works like clockwork. And again, these are weekly charts. You can't load the boat short on a company that has these type of weekly, a nice pattern of weekly sell signals, but you can use the daily and even 60-minute charts to help confirm these entries. So let's take a look from a weekly point of view, from a longer-term swing trading perspective. Again, if you follow the crosshairs vertically down, here's the first reading where you tagged and just went over 70, and look at that following ensuing correction there. Prices really didn't bottom until all the way over here, this level, so that would have been a great swing short. Here we went through, this is the latter stages of the bull market, leading up into 07, where euphoria is at the height, and we have prices punched through here, gave you an overbought reading. You could have made a nice short. Again, these are weekly candlesticks, so that's several weeks, couple months there actually, where you would have made a few bucks on a short, and hopefully the daily charts would have got you in and out of that short at the right time. Prices then never pushed all the way back to the 50 level, and this is something I was talking about a minute ago. This is these circles are what I call extended overbought readings. And let's take a look at this one. So prices went above the 70 level. We had a small correction. They came down somewhat and then pushed back over and remained above that level for quite a bit of time. This is why overbought can stay overbought for some time. We've seen that before, and we'll see it again. But typically, the longer a stock stays overbought, the harder it falls. So you can look to see what happened after that. Of course, a lot of that was attributed to the bear market, but again, the technicals are the technicals. This was built in advance of this. There were a lot of excesses, as there are at the top of every bull market. So let's take a look. As you can see, our prices didn't even come close to the RSI 70 level since then, until the bull market started and was well underway 2010. We're looking at the first little bit of a spike right here. We didn't have much of a reaction there on prices. Had you held onto that short for just a few weeks, prices ramped up, you would have got underwater a little bit up to this level, and then you would have been rewarded and made a pretty nice trade there. Prices came down, and they did offset those overbought conditions quite a bit. We came down here, hung around to the 50 level, but didn't go below there. So they were somewhat in overbought territory, or at least on the upper side of the range, and got quite extended here again. leading up into early 2011, and you can see here finally prices succumbed and came down quite a bit. Very sharp correction. And since then we hadn't had any overbought readings until this level here, and once again we are in what now I call an extended overbought condition. We've been overbought on Comcast since it looks like really at the beginning of the year. Prices dipped down a little. We did have a little correction from that, but not much. We didn't even make it back down to the 50 level. Prices pushed back up with very little corrections. My expectation on Comcast, as well as a lot of other stocks, when the dam breaks, it's going to come down pretty hard. I think you'll see a sharp correction in Comcast. I don't know if that's going to happen tomorrow, next week, or next month, but I think Comcast is looking to be about a good short here soon. Zooming forward to the daily chart, these are how you time your entries. Personally, I wouldn't short anything off a single sell signal on a weekly chart. I would use that in combination with the shorter term charts. And your entry for Comcast would be on this daily chart. Here's a nice, clean, bearish rising wedge. Like a lot of the other patterns, negative divergences across the board confirming that. So a break of this trend line here, this uptrend line, would be your entry on Comcast. That's the first target, and I'll probably add that on the site as a trade later. Okay, folks, I ran over a lot longer than I wanted to, but hope you found this video helpful, and have a good trading week. Talk to you later.